Hello, everyone, and welcome. So happy to be able to do this Q&A webinar for Klamath Falls. We had a great response, over 178 people registered, so looking forward to answering your questions. Hopefully we got to see, some of you at our live event, and we'll certainly do another one because we got to learn a lot about what you want to know, your questions, and that's why we're doing this, to answer them. So welcome. I know a lot of you are watching the replay, so we will go through the questions that were sent prior to. All right, so we're talking about new homes in Klamath Falls, and it's called Ridgewater. Beautiful, beautiful place. This is a syndication, and this is a presentation, basically a marketing presentation, but the actual offer is in the private placement memorandum. And you can get that, you can download it at growdevelopments.com. When you click on the Invest with Us tab, then it'll take you to our portal called Invest Next. And when you sign in there, you'll be able to see past webinars and the overall summary of the project, and you can download the PPM there along with the operating agreement. The strategies mentioned here may not be appropriate for everyone, so be sure to speak with your attorney or advisor to make sure that it's right for you. And of course, we're going to do our best to project how we think things will go, but you never know what comes in the future. 2020 taught us that. So past performance, of course, is no guarantee of future results, but it does help that Fred has an amazing track record and that we've done, 11, 12, 13 deals now together over a 14-year period, and Fred's been developing far before that, before we met. Okay, so today's agenda, you're gonna get to know Fred a little bit more if you don't know him already. Talk about why Klamath Falls, talk about the business plan for this project, details on it, and how you can subscribe and be a part of it. This is available to accredited investors only. We wish we could be more flexible on this, but we can't be. It's filed as a 506c, which means you need a third party to verify your accredited investor status, and our team will help you with that. Or you can go to verifyinvestor.com, give them the information they need, and you'll get your certification there. There's no education you have to take. It's just verifying whether you meet one of these three criteria. You don't have to meet all of them, just one. One is to have a net worth over $1 million, excluding your primary residence. Have income over $200,000 if you're not married, or $300,000 if you are, in each of the prior 2 years, and you expect the same this year. Or you have Series 7, Series 65, or Series 82 license. That's probably a great way to get accredited if you don't meet the other standards. Of course, it's not the easiest thing in the world to get those licenses, but I think the 62 isn't too hard. So Fred Bates, Fred, welcome. Fred,
how are you?
Good. Fred has over 45 years experience in real estate development and construction, encompassing most product types. I come to him for advice all the time on different things, and usually tells me not to do them. He's very conservative. An engineering graduate of Michigan State, and experience with all aspects of development business, including acquisition, entitlement, design, construction, and finance. And we have a long history together, starting back in 2010 with Riverscape project in Portland, all the way through till now. And you can find information about those projects at growdevelopments.com under our past projects. But here's one, Riverscape, such a beautiful project that Fred picked up that looked kind of like this, but the interior wasn't finished. Never had its CO. It went to the bank. When the bank failed, the FDIC took it over. It was worth about $20 million or more, and Fred was able to pick that up for $3 million. We finished it out. Investors made over 20% IRR during the depths of the recession back in 2010. Dublin Crossings was another really cool one, entitlement project where investors did really well. I think they made over 30% on that one. Fred took a couple of those lots and built a building for Dublin Challenge Dairy. We still have that. We're still holding that. Investors are still involved in that one, but the initial investors got paid out 20%. Lots of projects. We just did the Bait Stringer Reno and Quest. And those, if I'm not mistaken, Fred, these are the ones that the city of Klamath Falls knew about and contacted you because they needed more housing up in Oregon.
That's right. They're looking for more housing. They have a demand for housing that they can't meet. They have over 2,000 new jobs coming into the area, or many businesses coming into the area that are going to provide over 2,000 new jobs, and they need housing for these people. I think I told you typically they were pulling anywhere from 80 to 120 building permits a year, which will come nowhere close to meeting the demands over the next 3 to 5 years.
So for some reason, they found out about our project in Reno and gave Fred a call. He went up there, looked around at a lot of different lots. We're going to talk about what he saw and why he chose this one as the one that can help bring more supply into the area. We're also still currently working on the Prescott Ranch in Bozeman, Montana. When Fred first brought this to us, I didn't even know where that was or why he was picking this market. He knew about it because his daughter was going to college there, and he saw that it was difficult to get housing for her and expensive, and that there was very little supply. So he said, I think I'll help them with that.
Well, there's even a bigger story that goes with that. I mean, we had concluded, as you know, when we made the move to Reno, that it was just too hard to find lots in the Bay Area, any place in California anymore, that where you could build a house for a favorable price and sell it. So we made the move to Reno. We were able to get some land up there where we could compete. But as time went on, more public builders came into Reno, bid the land cost up so high that we can no longer afford to buy land in Reno. So we made up our mind that we would go to these mid-size markets like a Bozeman, like a Carson City, like a Klamath Falls, like Twin Falls, places like that, that have a demand. They're in that range of close to 50,000 people that are growing fast, have a lot going on in the town, and we become the largest builder in the area. And we're able to, like up in Bozeman area, we're able to build and sell superior houses for about $200,000 less than the next builder.
Amazing. Okay, let me see, where did it go? And then Little Lane is a project still in process in Carson City. This one has been extremely challenged by COVID, by the shutdown of the city there. But you know, it's a matter of time, right?
Well, there was a couple of things with this product. We did come out during COVID, and we languished in getting it started, waiting for the city to respond to our submittals and to our engineering and whatnot. And then once we were able to pull permits, I would say that I kind of missed the market on this. I thought that Carson City was a little bit more sophisticated than it is, but in fact, we have kind of languished. Now, we've changed our marketing plan a little bit, and things have picked up already this year, so we'll see if that holds true. But we will work through this, and we'll get it out. We're right now almost a third sold out. So,
yeah, and I mean, it's definitely a tough time to be building homes through COVID, not being able to get supplies, and then finally when you can get the houses built, then interest rates went up. So definitely some challenges there, but interest rates coming down a bit, that should help, and the new sales team that you have. Oh. Okay, so moving on to Klamath Falls, for those of you who don't know where it is, it's right over the border from California to Oregon, just right kind of east of Ashland and Medford. It is 20 minutes north of the California border. People are moving there because of low cost living and available jobs in growing sectors in healthcare, education, and military. And as I said, the city needs more housing, which is why they called us. Residents also enjoy easy accessibility to diverse range of natural beauty. It's really beautiful up there with the Cascade Mountains, the high desert, waterways, and Crater Lake. It's also an outdoor tourist destination for boating, hunting, fishing, hiking, and camping. Some of the big employers are Kingsley Field Air National Guard, home of the 270 Air Traffic Control Squadron, and 173rd Fighter Wing of the Oregon Air National Guard. The squadron currently flies the F-15 and is scheduled to get the new F-35, and that should bring in, they're going to be doing some training and bring in more pilots. Anything else you want to add to that?
Yes, it was as a result of this contract that they have with the Kingsley Field Air National Guard that they started a search for builder developers. To get that contract, they had to commit to delivering more homes in that area. The colonel out there told us that they were going to have a demand for over 300 jobs themselves. And these are going to mostly be officers that are going to be there in training or training, and they'll be there for long term. The question that somebody asked one time was, can they afford these houses? And they will get a supplement to help them buy houses in this area.
Okay, wonderful. So the business plan is pretty simple. We're going to build high-end homes to sell to the retail buyers there. But the really unique thing about this, for those of you who have fear of development, or what if these never get built, or there's challenges, a lot of those risks have already been mitigated because we don't have to buy the land or develop it. We just get to build houses and sell houses. And that is what Fred does. So we don't have to actually pay for the land until the house is built and sold and closes. So it's an option agreement with the seller to purchase 156 finished lots over the next 5 years. Fred negotiated a pretty much unbelievable deal here that we only pay for the lots when the homes sell. I honestly don't know how you did this, but $60,000 per finished lot. Those lots are worth maybe twice that. And for the first 139 paid at the time homes are sold, and the last 17 lots will then be signed over to us in consideration for the $1 million option payment. So again, how did you make this deal?
There's no money wasted. Yeah, there's no money wasted in this. Well, we had a fellow that is a farmer out of California that purchased property at a very good deal during the recession, 2008. I think he bought this property. He's been doing lot sales programs over the last few years. He's not really a real estate person. The lot sales are relatively slow. If you can imagine, the people that are buying these lots are new businesses going into the area, but a lot of California retirees and so on and so forth that are going to that area. And they're really looking for a house. They don't want to take on a job. They're retiring and moving to a house. That's what's been buying there. These are people that, if they were to buy a lot from him, they would then have to hire an architect, they'd have to hire a contractor, get a construction loan and a takeout loan and so on. And over the next couple of years, they might have a house. When in real terms, what they want to do is drive up, see something they want, buy it, move in. So he was anxious to find somebody. The city was anxious to bring somebody up there. They put us together with him, and we were able to negotiate a deal.
Yeah, it's a fantastic deal. So again, investors get a 12.5% preferred return. The way the capital flows is as homes are built and we pay for the lot once the buyer comes in and we close, then the landowner gets their money, and the profits come to us immediately because we didn't have to buy the land. We didn't have to spend all that money on development. So the profits are split right away, and the first money that comes in goes towards paying capital back, which you believe will happen, this as soon as this year.
Yeah, the first dollars in will be, we should be able to be closing on houses within 8 months of when we start. If we can get started here in April, 8 months later, we will be closing houses and we'll start paying back capital.
Yeah, so capital first, and then the 12.5% preferred return. That's per year based on money that is invested. And then after that, you get a profit split of 25% of profit to the investor.
Correct.
So we tend to structure our deals with a higher pref on the front. I don't think you probably see a preferred return this high anywhere else. But this is just something I negotiated with Fred a long time ago that I thought it was more beneficial to investors to have that preferred return up front and a smaller percentage of profits so that we'd be more incented to or incentivized to get through the project faster. Because the longer it takes, the more delays, the less the GPs, the general partners make, the more the investor makes. So it incentivizes us to get through this project faster. So that's why we structure it this way. We expect it to be about a 5-year hold.
That's at
And
30, at 36, at 36 a year. So 3 a month is what I performed this on. That would be a 5-year hold. We may be able to sell faster than that, in which case we would get out quicker. If we, for some reason, we're slower than that, it would take a little bit longer. Right now, we have it, the performer that I have at 3 a month, we would have their capital start coming back in 8 months. After 34 months, they'd have all their capital back and they'd be into preferred return and then profits.
so the property is beautiful. You can see it here. It's forested with rolling hills. So a lot of the lots look over the lake. It's in a gated community, Ridgewater. You can see beautiful pond at the entrance, a little gatehouse and a small lake. There's 156 finished lots, and the average size lot is in excess of 0.64 acres. So if you would, just explain the value of a finished lot for those who don't understand development.
Well, we're going to talk a little bit about this when we get to the question and answers part, but in development, we have 3 levels of risk. I mean, we have the entitlement process, which is where there's the most risk, and you start with nothing and you may end up with nothing. You spend hundreds of thousands of dollars, maybe over $1 million entitling a piece of property. Then the second level of risk would be if you have paper lots. Now, paper lots would be ones that have entitlement and that we would be able to go in and build the finished lot on. In other words, put water, sewer, utilities, streets in place. And then you have this particular case, which is the best scenario, where you have finished lots. And in this case, streets, water, sewer, all your utilities are in place, ready to go, ready to pull a permit and start building homes. And that's why I say we can start in April. As soon as the weather is such that we can go in and start doing foundations, we're off and building.
Okay. This is, again, just to give an idea of the
Beautiful, isn't it?
scenery, the road.
Yeah.
This is,
You've got meandering roads, undulating terrain, heavily forested. And like I say, large lots. So people who build and live there won't be sitting right next to their neighbor. It's going to be something like we haven't offered to any of our buyers in the past.
yeah, you can see here the farmer who developed all this land and did the, took on the builder risk or the developer risk, did sell some lots. There's some homes there. These are beautiful homes, not necessarily starter homes.
No, these are all custom homes, yeah. And our homes, while there'll be production, will be every bit that good for less. We have people who have bought lots that want us to build their homes for them. We've got a list of people now who want us to build homes for them. So it's starting out good.
Great. How do they know about it already?
Well, he's been marketing lots. Now, when people go there, he lets them know that they're sold, that there's a builder coming in, and they put their name on the list. We will start our own marketing in about 2 months. We've got our campaign all done. We're ready to spring it on the market as soon as we get started.
Okay. And so you can see this. Yeah, there's the star. That's where the property is located. Here's the town. Not a big town, but it's not too far away. There's the lake. And with the finished lots, most comps that Fred looked at were not finished. They needed wells, septic tanks, and were accessed by dirt roads, or they were small lots in the city. So again, when you say they weren't finished, like they weren't permitted, they didn't have roads.
To understand this area, of course, we had to go out and do a thorough due diligence. And when we went out to do comps to try to put a value on these lots, there were lot prices anywhere from $29,500 to $185,000. These lots are better than anything we saw, and they're all finished. Whereas a lot of the property we saw, if you can imagine, would be just kind of a semi-rural lot, dirt road going out to it. Utilities may or may not have been in place. It was hard to get comps in that. However, we were able to get comps on some nice houses that were being built. Interestingly enough, these builders build one at a time. They sell them while they're still under construction. They do very little advertising or promotion, but everything they build is sold. And that's what I'm talking about. These people pull about 190 to 120 permits every year, and everything is sold every year.
Wow. Okay, and yeah, you said the comps range from 29,000 to 185,000. Typically, you purchase the land, entitle it, subdivide the property, design, engineer, finish the lots, and start the building the homes. So that whole huge first piece of, first is getting the permission to even build, getting that entitlement. And then, so just getting sewer in there and electrical and utilities and the roads, that's a major undertaking. And that's oftentimes where builders or developers go bankrupt.
Right. And it's all in place for us. And again, we don't have that big $9-10 million land acquisition cost sitting in front of us. We're not going to pay for that lot until such time as we have a third party buyer in place and we're ready to close escrow.
So again, to be able to finish the lots that we're buying, the cost would be 95 to 115,000. So again, Fred did us a huge win here in his negotiating skills, and we're getting them for $60,000 and don't have to pay for them until closing.
$60,000 is a finished lot. The 195 to 115,000 is just finishing costs. So we're getting land and finished lots, the roads, so water, sewer, and everything for less than it would cost to finish them.
Yeah, amazing. Okay, so the product type. Tell us about this.
The product type is going to be similar to what we're building in Bozeman. We've modified it, we've upgraded it a little bit. Because we have big lots, we can do all 3-car garages. So all of the houses that we build will have 3-car garages. We will have an optional detached garage for those people that have RVs and things like that. And we'll have an option above the RV garage for a granny unit. So these houses will have a lot of opportunities, a lot of options for our buyers to make selections from.
Okay. Here's some samples.
These samples show 2-car garages because we took them from existing product that we have that we've modified for this project. Our modifications are done. I should get those out to you.
Yeah, so people might go online and say, well, it looks like a small market, and it's true. It's not a fast-growing market. There's 80 to 120 home building permits pulled per year, probably a lot less than where any of us are living. But we're planning on selling, what, 3 a month, so you're not worried.
Yeah, just 3 a month, just 36 homes a year. We can fit nicely into that if that was the only market, as we've learned since then that the market is much bigger than that. The upcoming market is much bigger than that. But we have superior lots to any other builder, and our production cost, because we do true production, we can build a superior home at a lower price. So we'll be offering more for less.
Yeah, can't argue with that. So comparable properties, average home price is pretty low, 300,000. Ours is going to be higher than that, 650,000. So that's a big question people have, is how are you going to sell it if it's so much higher than the median price?
Well, the median price, when we went into the Bozeman market area, if you look at the Belgrade market where we're building our homes, the average price home when we started building in there was around $300,000. Maybe 280, I can't remember. It's now over $500,000. Our average price has gone from about $500,000 to close to $650,000, $700,000, and we pulled that up. The average is going to be based on the numbers, and they just don't have a big enough number of nicer homes to sell. As they do, they will sell.
Yeah, they just don't have them. Yeah.
Yeah, there's just not enough of them.
So the offering documents, the minimum investment is $50,000. You do need to be accredited, as I said. Total offering max is 10 million, but we think we only are going to need 8. Minimum raise is 4 million. We're more than halfway there, so soon. Use of proceeds, the investor funds will be used primarily to build the model complex so people can come in and see the quality of the build and walk through the models. And then also construction of 18 houses for sale. The purchase price and the other fees and expenses due under the option with respect to the initial 18 lots. The cost of setting up, the legal fees, accounting fees, design, architectural and engineering, and construction of the model homes complexes and the initial homes for sale. And here's an analysis from the PPM. This is Exhibit F. You can see when you're reading this, it might be confusing, but there's a number of units. You have 39, 39, 39, 30. These are different styles of home. One is 1,800 square foot, one is 2,100, 2,600, 2,800. This is the building cost for these different homes, base sales price for the different sizes, upgrades, lot premiums, and then the net sales price per square foot for each different type. Then same thing for the different types. This is the direct building costs, all the costs on there. So the net profit after sales commissions, sales and marketing expenses, the models, construction on-site, and then the fees, you can see the net profit is over 100,000 per sale. And again, as Fred said, once those homes are sold and there's that $100,000 profit on the first one, it can get distributed immediately, right?
Right, because typically, as you know, Kathy, we do take these buys and takedowns. So we would do a phase 1 takedown where we're buying land, and then we have to do phase 1 site improvements. We sell out the homes and we have to turn around and set the money aside so we can do phase 2 infrastructure, phase 2 homes, and so on. Where in this case, the only capital we're raising is for models and for our production homes. And so as soon as we start selling one, we start making profits. You'll notice in the pro forma that we did on this thing, we didn't put anything in for inflation, but in every one of our projects, we're experiencing good inflationary trends. So I think there will be a number there that will help this bottom line. As you said before, we were starting out, we were going to raise $10 million. Now we've got all our costs in. We don't need 10 million. We're going to raise 8 million and shut it down. So what does that mean? It means that your percentage of the profit share will grow. It also means a faster return because we have less capital.
You can see with this gross profit, 17 million, we're raising 8. So it's, you know, if the properties don't sell for what we would think they would, there's still plenty of room. There's a big cushion there. So this is again the cash flow scenario with the raising the full 10 million, which we don't think we will have to. Here's the scenario with 8 million. Again, gross profit of 17 million. That's a pretty fabulous return and a big cushion if things don't go exactly as planned. Oh, let me see. So let me go back because there's more numbers that I'm sure people want to see. So this is the investor preferred return would be 1.6 on top of the 8. That takes it to 15 million, and then investors get the additional 25% of that.
right? It shows a distribution of profit to the investors there. If you want to go back to that. Now, this is based on the 8 million that we're talking about. So what happened here is your profits actually grew, but the investor 25% would get $3.8 million back in profits. They get their 8 million back. They'd get a preferred return of a $1.6 million back and profit of 3.8 million. So about 13,000. 13 million on a $8 million raise, and it comes down to about 84,000 return on a $50,000 initial investment, or 34,000 in profit. And like you said, it's a conservative. It's a very conservative risk. Now we bring all kinds of projects to you, Kathy. I mean, from entitlement projects to something like this. This would be the most conservative because the only risk we have out here really is time.
Mm-hmm. So again, cash flow scenario, raising 8 million. This will all be in the PPM as well when you download it. Estimated timeline, capital raising until March is when the deadline is, I think, March 15th.
Right.
The funding minimum, begin building. We're saying January, but with the weather, we're most likely be April. But you've kept this project moving along on your own.
Everything's moving along. We're in right now for our structural engineering. So that's on our trusses and whatnot. As soon as that's done, we can pull permits and start building.
So yeah, the idea was to start returning capital late 2024. I would expect probably closer to early 2025. Expected a 5-year hold at those 3 sales per month, but it could be faster than that depending on demand. It could take a little bit longer, six years or so. That is the estimate. But in the meantime, you're still getting checks. You'd have your capital back far before that 5-year period. Then it would just be preferred return and profit after that. Distributions, again, we went over this, but first, as each home sells, we get to distribute cash. That's very unusual. We don't normally have that situation. That first cash goes to return of capital, second to the preferred return of 12.5%, and finally, the final profits are split 25 to investors and then split among the partners. And then fees on top of that, we obviously have to be reimbursed for professional fees, legal fees, accounting fees, the Bates property Reno assignment fee of $500, grow management receive $50,000 for the startup fees for the work that goes into us reviewing it and marketing it. Bates Properties, Reno, and Grow Management receive a management fee capped at 2% of total gross revenue. Grow Management will receive $1,000 per home or lot sold, and will be helping also market the sales of these properties. Fred Bates Jr., and this is a question that comes up a lot, like what's your plan if anything happened to either of us? And your son is Fred Bates Jr., and he is the builder. So he will receive a monthly. Oh, go ahead.
Yeah, it was interesting at the live event when we were talking to people, and they wanted to know what the succession plan was. And I told them that my son, who is our general contractor on all of these developments, would simply take over. He handles 90% of all the day-to-day as it is now. But they were surprised when I told them he's 57 years old, been in this business for a long time too. Yeah. So yeah, he's not a rookie by any stretch. And
no spring chicken there. So right. Yep. All right. So there's the fees. Potential risks, supply chain issues. This was big during COVID. Do you see that being a problem, getting the materials you need?
We're still seeing a little bit of it, but it's getting less by the day. So I would say that I think it's still good to mention, but I don't think it's going to be much of a problem.
Construction delays, lack of workers up there?
No. And as a matter of fact, we're taking a team up from Sacramento. a whole
Okay.
construction team up, everything from drywallers to painters to whatnot.
Wonderful. Enforcement of the option agreement, any chance he'd back out?
I have to go with what our attorneys say. Our attorneys say that our option is ironclad, so I'm not worried about it. The risk, as a risk factor, I'm just not worried about it.
Changing economic circumstances, of course, that's always possible. It's not showing any signs of it yet, though. Not with the
Yeah,
job growth we've
I
seen.
think, yeah, I think things are going to get better. I can't tell you exactly when, but I do think interest rates will come down, which is something big for our industry.
Mm-hmm. Yeah. Illiquid investment, that's important to understand that, once you invest in a syndication, that money has been spent. It's spent on building these homes, and we got to sell the homes before we can get your money back to you. So you just have to understand it that, it is illiquid. It's not like a stock that you can just trade. Changes in market conditions such that homes do not sell as quickly as anticipated. We just take longer, right?
It just takes longer. And like you pointed out, Kathy, we've got $17 million worth of profit. So they're going to certainly get their money back. And as you know, every investment we've done with you people have got their money back. And they're going to get their preferred return before we get anything. So we're in the business to make money. So we will be pushing it along as fast as we can.
Okay, and again, we talked about reliance on key personnel. You have, your succession plan in place, and we just can't be on the same airplane together. How about that?
That's right. There you go.
All right, lack of qualified buyers such that homes do not sell as quickly as anticipated. Again, that just means it would take a little bit longer. Okay. Reporting, we'll be reporting construction progress, give you photos, contract sales, status of development, quarterly unaudited financial statements, information reasonably necessary for the preparation of the K-1s, and other reporting as it becomes useful. And then you probably all know Ann Triplett and Kathy McBride. They have been investors in a lot of our projects. Ann was a member before she came on board to help us out. And they can really just walk you through the process if it's your first syndication. Excuse me. So all instructions are on the portal. Just go to growdevelopments.com. Or you can send your questions to syndications at Grow Developments. All right, let's see if we have any questions. What happens if we can't raise the full $8 million?
If we get close to it or anywhere near close to it, I will loan the difference in. But I think the way we're moving right now, I think that we will raise the 8 million. There's a second option that I have, and that is in there, as you know, if we get to 4 million, I might go out and put a loan on it, and it would be obviously secured by me because we're not owning the land in this, but so it would be partially loan and partially capital at that point.
Okay. What is the fiscal year for the company?
I think we started the company. I think we do everything on an annual year, but I think our company started. I can't remember. Was it November or December? I can't remember.
Okay. Yeah, well, we can get back to you on that. Somebody wants to know, they would love to invest in this, but their money's in Bozeman. So if the timing worked where they got their, full capital back.
Yeah, there will be a capital return coming on Bozeman. Now, they've got 60% of their capital back. The remaining 20% will come back in 2024. However, I don't think, I wouldn't want them to rely on that to do this project. I mean, the capital will be coming back, but this is something that they want. We're probably going to be putting to bed in the next month or so.
Yeah. Somebody wanted to know if there was accelerated depreciation or tax benefits. And this is not a buy and hold type investment, so I would say probably not.
No, there's none of that.
Yeah. And just take the documents, the offering documents to your CPA to see how you are personally affected, because it's different for everybody, and the money that you use to invest might be taxed differently. So just make sure you understand your tax implications, and your CPA should know when they read it. Minimum investment is $50,000. Can you talk about the Oregon state tax and how that will be handled?
Yeah, now, as you know, Kathy, I'm not much of a tax expert, but um, there will be an Oregon state tax. As you know, each one of these houses, there is a profit. And so there is going to be an anticipated or an allocated profit to each one of our investors, and they will have to file and pay an Oregon state tax. The company will be requesting that all of our members complete an affidavit for the state of Oregon that states that the investor will be responsible for their own tax. However, if that form is not filed with the company, will be required to withhold taxes at the highest tax rate on the investor's behalf. And those amounts will either be deducted from the disbursements that we make to the investor, or the company may request that we get reimbursed if we've already distributed money to the investor. One of the questions that people ask at our live session, I think their biggest concern was not whether they had to pay taxes or not, but whether they were, if they paid these taxes along the way, what happens at the back end? They will not be double taxed. So at some point, they will be getting income that they've already paid taxes on.
Okay. Most A&G personnel are part-timers and don't necessarily live there. How dependent is this marketing sales plan anticipate A&G personnel buying these homes?
Say that again. Who are these people?
A&G, I think, I'm guessing it was, I'm not sure. Can you explain what A&G means? All right. Will investing through an IRA be an option? Yeah, you can invest in your IRA. Just make sure that you speak with your CPA to see if there's any way that you could be taxed, because it is a business of buying and selling homes, which means that there's a chance it could have unrelated business income tax through your IRA. So just make sure that you show the documentation to your CPA. Now, even if you were taxed, it may be that it would be very small. It just depends per person. And how much you've already paid in that UBIT tax. So just run it by your CPA. Oh, the Air National Guard. Of course.
Oh, so say that, give me the question again on the Air
Okay.
National Guard.
Most Air National Guard personnel are part-timers and do not necessarily live there. How dependent is the marketing sales plan? Are we depending on them?
That's true, but all of the people in the Top Gun program, the trainers, the officers that train these people. And when I talk about training, I'm not talking about just flight training. I'm talking about the mechanics, every aspect of it, are full-time people that will be there full-time, training the Air National Guard people that come in. Now, they've already got a big presence there, but they're talking about 300 more permanent jobs. And they're talking about these people. Most of these people have the ability to buy a house. They're coming into the market with equity. This will probably be, in many cases, a cheaper market than they're leaving.
Okay. Okay. Will 1.5 shares be acceptable? Yes, it's a minimum of the 50,000, but then beyond that, you can invest what you want. Okay, great. Now we also had some questions. Y'all can keep adding questions while I do this, but Fred, you sent a questionnaire from questions that came up a lot at the live event. I think you've answered a lot of that, but again, one was, what makes you think you can sell 156 new homes in the area? And you broke it down, well, it's 3 per month. Do you think you're being aggressive?
I don't feel that we're being aggressive. This is a question that came up at the live event. could we sell, what makes us think we can sell 156 homes in a small market like this? And I'll agree it's a small market, but like I pointed out, they're selling 80 to 100, or they're pulling 80 to 120 building permits every year, and they're selling these homes. Most of these homes are spec homes. They're built by general contractors just like ourselves, only they do it onesie twosie. And they're selling homes in that 700 to $1 million plus price range. A lot of them are cheaper, granted, but they are selling expensive homes. We're talking about only 36 homes. Now, yes, we might put small builders out of business because we will be able to build a better home for less money and provide it on a much better lot. I think when people come into our area and they see our model homes, they've never had a chance, the people that buy in that area never had a chance to look at a model home before. All they do is walk in and buy homes off the floor plans that these guys are building. So I think there's no question that we can build 36 homes a year in that market. And then when you couple that with what the city officials are telling us, new business coming to that town, a lot of them are small businesses, tech businesses and whatnot, going to be bringing in over 2,000 employees over the next 3 years, along with what the Air National Guard is bringing in. I think that it's almost a slam dunk. Now, worst case, it might take a little longer. Best case, we get it done in 3 years.
Okay, let's see. So why was the farmer willing to basically sell these lots for, half what they're worth?
Well, I think that he realized that he wasn't a builder developer and that most of his people wanted a house. And so I think it was time for him to move on, do the next thing, So we made him an offer. I think, well, kind of, I think, but I think more importantly, we made him an offer. I think that he and his financial people took a look at it, saw that it worked, came down, looked at our product. Matter of fact, he's going to be down again this Thursday looking at our product again, because he himself feels that he wants to invest in the models that we're building. He would like to buy the models back. He feels strongly about this product, this project, and whatnot. But I think in everybody's case, there's a time to move on. In his case, he got a very good buy on it. And I think that the way we proposed it, and he'll be out of it in 5 years, I think he saw that as a real good opportunity.
You discussed risks, and this project has fewer risks than others. Explain again.
Well, if we talked about risks, and we as developers put these risks into categories or degrees of risk. The development category is the riskiest. And by that, I mean taking down a raw piece of land with no entitlements on it. There's anywhere, up to 100 different items that you have to address. If any of one of them come back negative or with a remediation required, it's an opportunity for city officials, planning commissions, county officials, who's ever overseeing this project, to deny the project. In no growth areas, of course, you can spend hundreds of thousands of dollars, people nodding yes, and still get to the podium. And you have people coming in saying they don't want it, neighbors saying that they don't want this development, and swaying the votes to a no vote. So at any time, it can go bad for you. It's a risky business. We do it every day, but it's a risky business. We know it's risky, and we try to mitigate that in our due diligence. A less risk would be paper lots. I call that more of a moderate risk. Paper lots have all of their approvals. You have all the mitigations have been met, but we still need to build the lots. So what can go wrong there? Well, yeah, I mean, we've seen it. You get your subs in place, they can't get off the ground because of weather. City officials can't get things checked off, so they're holding you up for project checks and whatnot. Prices change as you're doing it. So many times you run into on-spec delays with all of it, contractors, weather, soil conditions, code requirements, they're constantly changing. Utility companies, city sign-offs, all of it. And then the smallest risk is what we're looking at right here, finished lots, ready to go. In this particular case, as soon as we get our house out through the structural engineer inspection, we can go ahead, pull permits, start building houses, and no questions asked.
So another question was, why wouldn't we always just buy those finished lots?
Well, I think there's a number of reasons, but the two prominent reasons are that, for example, we were builders. We used to build about 600 homes a year in the Bay Area. And because we were doing good, and there were a number of small builders like us in the Bay Area, then the national companies came in, and they have to do, each one of their offices is doing about 5,000 homes a year. And their stock is based on the number of widgets they sell, not necessarily the amount of profit. Now, profit's important too, but it's still the number of widgets they sell. So if you have a Toll Brothers or a Lennar or whatever in the Bay Area, they're trying to knock out 5,000 homes a year. They're bidding on these lots. There's not enough lots come up in the Bay Area to satisfy their appetite. So the prices get higher and higher and higher. And of course, Kathy, when we did the Dublin project, Dublin Crossings, we entitled lots and we sold them at a huge profit to a public builder who went in and built the houses on them. So we can't compete in that market, or we're unwilling to compete. If we can't make a true margin on the house, we don't do it. So that puts us all the way back to, can we buy paper lots? Not typically in the quantity that we want to buy them. And in these small markets, not even finished lots in the quantities we want to buy them, where we can go in and put a model complex up, amortize the model complex over at least 100 homes. Most of these small developments that are getting approved in these small markets are 20, 40, 50, 60 homes, and they don't mean anything to us. These builders turn around and sell them out to onesie, twosie builders and do it over a period of years. We like to, where we can, go in, buy our land, buy egg land cheap, get it entitled, build the lots, and build our own homes. And that would be the model that we're following up in Bozeman and other projects that we've got moving on. And I think it provides us, we make a margin on the lots, we make a margin on the homes, and we're there over a period of time. So we get to enjoy the inflation. We get to amortize our model complex over a larger number of lots, so it's almost incidental. So I think it would be nice to be able to buy finished lots all the time, but it's just not in the cards.
Okay. Are you expecting cash buyers for these homes, or do you think people will be relying on loans, and will that be a problem?
Right now, people are getting used to the 6%. Our sales have moved back up in Bozeman and are picking up in Little Lane, and we're seeing it nationally that new home sales are picking up again. So people are getting used to the 6% loan area, 6 1/8, whatever it is right now. So I don't think loans are a real problem. Most of the people coming into this market are going to have good cash down payments. But the new phenomena in Klamath Falls is the California retiree that's starting to move up there. He's coming up there selling a home in California and walking in and paying cash. So that's something that we hadn't counted on when we first looked at the market, but is becoming a bigger and bigger role in our project analysis.
Yeah, at that price point, it's nothing for a California homeowner who's maybe, owned their home for 30 years or whatever. Yeah, it's definitely.
Yeah, just think, Kathy, our Argos product that we started selling at $600,000 is selling for $1.5 million at resale. People that didn't buy, and people are starting to figure this out, people that say they're going to wait a year or two. Prices of homes went up 20 to 30% over the last couple of years. You can't set money aside that fast. If a $700,000 house goes up 20, 30%, people aren't saving $150,000, $200,000 a year.
Yeah.
So I think people have figured out, and they're trying to buy where they can. And in addition to that, there are no resales on the market, because if you own a home, you don't really want to sell it unless you have to, because you know you're going to have to get rid of your 2% mortgage and go get a 6% mortgage someplace.
Yeah. It does make sense. Do investors have an option to purchase a home at a discounted rate?
What we do for investors is we don't charge them any premiums. So let's say it's a corner lot where we typically have a $15,000 premium. And I'm not talking about this project. I'm talking about one of our typical projects.
Mm-hmm.
We would have a corner lot that we would charge a $15,000 premium. We'd have, you can go in and you can pick all kinds of upgrades, and we charge you our cost as opposed to any profit on the upgrade. So if you put a bonus room on, let's say it costs us $15,000, it costs you $30,000, you'd be paying our $15,000. So we don't make margin on any of the upgrades. If you upgrade your flooring, you upgrade your tile, whatever it is in the house, we don't make any margin on that. So you can save, I mean, in one of our Morgans, which is our small product type up in Montana, one fella from San Francisco came in and put over $200,000 worth of upgrades in. Now our cost was about $100,000. So he would have, or you would have saved $100,000 on it. So yes, if you're one of our people, we will do that for you.
Okay. Well, that is it on the questions, and we're at about an hour. So thank you, Fred, for sharing all this information and joining us tonight. And thank you all for joining us. Again, you can just go to growdevelopments.com to get all the information and paperwork. You click on the Invest tab, and that'll take you to Invest Next, and you'll get all the information. Okay, have a great evening, everyone. Let us know if you have questions.
Thank you so much, Kathy.
All right, bye-bye.